Hello, and welcome to Portfolio Matters, weekly markets checklist, week 143. Happy New Year to all our viewers. But before we get going, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. And Happy New Year to everybody. What do we have this week, Keith, after our break?
First of all, the news. So Angola has left OPEC, saying that it got nothing out of its membership of OPEC and it didn't want to cut production in line with current OPEC policy. And instead, it wants to grow its production. And by leaving OPEC, it feels that it can attract Chinese investment and do just that. Now, that leaves OPEC with only 12 members and crude production of around 27 million barrels a day, 27% of the 102 million barrels a day market. So OPEC's production is falling as a percentage of world production. That gives it less influence. Now, of course, it has expanded to OPEC Plus, which gives it more production it can control, but its influence on the oil market is waning, it would seem, limiting its ability to control the oil price. Now, Houthi rebels in Yemen have been targeting shipping in the Red Sea, disrupting global supply chains, and the US Navy has responded by sinking some Houthi boats, all of which puts off international shipping, which is increasingly diverting around the Cape of Good Hope and therefore adding time and expense to its journeys. The New York Times has sued OpenAI, alleging that the company is infringing on its copyright by training its AI software on old New York Times articles. That is quite an interesting and important legal battle. Let's see what happens. And finally, oil rallied a bit on news that the Shahara oil field in Libya has been shut down amidst protests. So this is Angola. It was OPEC's seventh largest producer, and it is now leaving OPEC and aiming to attract Chinese investment. The New York Times is suing OpenAI and Microsoft. We will be watching that with interest over the coming year. And this is a chart showing global shipping, and you'll see a lot of it has been diverted round the Cape of Good Hope, and not much of it's going through the Red Sea currently. Next, the UK retailer warned that it may suffer some supply disruptions in the coming months due to delays in shipping from China. And as a result of all that, shipping rates have spiked. And on to this week's economic data. Richard, the UK.
Thank you, Keith. So UK house prices month for month unchanged, bang on it in line with expectations actually. And house prices nationwide year on year climbing back up to towards zero. I noticed that there's a lot of mortgage applications going on at the moment, and the interest rates being offered by building societies and banks are falling in the UK.
Well, that's because UK bond yields, longer term interest rates had been falling sharply. They've bounced a bit this week.
Well, that will help, one would expect, the housing market. The UK global manufacturing PMI is still below 50, and basically it looks like it's still heading down. It's not a nice looking chart.
Yes, that's the final estimate, and it was revised down.
Yeah, right. And UK global services PMI was actually going back up, and it never really went much below 50, and it's now rising again. So that is good news for the service economy.
Yeah.
And the global composite, which is a combination of the two, is a little bit above 50.
Yeah, that's actually not that bad. According to the PMIs, the UK economy is not doing well, but it's not doing badly.
Agreed. Particularly the services PMI. So UK Bank of England consumer credit is 2 billion a month. Now, it says consensus expectations better. But question is more debt good or bad? I would say that's an existential question.
Yeah.
But on the basis that more debt is good, it's better.
Yeah. Well, it shows that consumers are willing to borrow. Whether they need to borrow is another matter. Yeah. Maybe they're desperate.
Yeah, it helps keep the economy ticking over. And net lending to individuals in the UK is above zero. It never really fell below zero, did it? So it's just bouncing around quite near zero, but that's not particularly problematic. And UK mortgage approvals is rising, and as you said, I think the latest news is that it's rising further. So,
well, this is the latest data for December.
Right. So, I mean, it's still been on a fairly sharp downtrend. It hasn't come out of that downtrend yet, so we'll see. The money supply in the UK month on month, M4, has appeared to have peaked and is now, about a year and a bit ago, and is now falling very gently back down.
Yeah, but if you think that inflation is a monetary phenomenon, then the month-on-month fall in December is further evidence of falling inflation.
Yes. Yeah. So Citigroup Economic Surprise Index, which is a very, very noisy chart. I always find this very difficult to interpret. Anyway, it's below zero.
Yeah, the new data source. Because I actually think that the Economic Surprise Index is really useful. And in the case of the US, I think actually is probably one of the best charts over the last couple of years. So I've managed to find a data source for the UK.
And UK food inflation has fallen to 6.7% year on year, which is still very high. Non-food inflation moved up a little bit to 3.1%, leaving shop price inflation 4.3%. So basically all the inflation numbers are still heading in the right direction with a little bit of an uptick in non-food. But the question is, at what point are they going to level out? And indeed, are they going to go back up? Is the situation in the Red Sea going to introduce price pressures? So this is just showing the number of fixed rate mortgages that are coming up for renewal by their effective interest rate. So in 2024, we've got a lot of mortgages coming up for renewal that are less than 2%, or between 2 and 2.5%. And they will probably be renewing somewhere between 3 and 4%, not as much as it was, let's say, a year ago, is it, Keith?
Yeah, but the next half, you are certainly going to see further monetary tightening.
This chart suggests that the impact of high interest rates on UK homeowners, even though we've had them for quite a while now, is only just beginning. And you can see that the black line, this weighted average interest rate of the UK households, is at 3.1%, whereas the quoted interest rate in the UK is very nearly 6%, and somewhere between 5 and 6%. Yeah. So, but of course, if interest rates start falling, as they are, this chart, the black line and the red line may meet by the red line falling rather than the black line rising.
True. However, people will then have locked in mortgage rates for 2 years. Yeah. And so, lower interest rates won't help them very much.
Indeed, yeah. And UK mortgage arrears are on a rising trend, been on a falling trend since 2009, really, and now they're starting to rise quite significantly over the last few months. So, summary, UK manufacturing is contracting, service sector is doing well, food price inflation is too high, and the money supply is gently falling. And is the UK economy stagnating with near zero growth? I think probably it is. And with higher interest rates, are we heading into a deeper recession? Well, I think we probably are.
Yeah, well, I've been forecasting that for a while. And, the UK economy has been surprisingly resilient, but everyone now expects a soft landing, forgetting that, we still have very high interest rates, which are still impacting the economy.
And the effect of which has not yet been fully felt.
Yeah. Thank you, Richard. On to the EU. Well, we had the final HCOB PMIs. Manufacturing was revised up slightly to 44.4 against the initial estimate of 44.2. That is still a very bad number. So manufacturing in the EU is not doing well. Services was also revised up to 48.8 from an initial estimate of 48.1. And so, of the second estimate, the services in Europe are not declining, but they remain in recession. All that leaves the composite unchanged at 47.6 in contraction territory. So the Eurozone is in recession and not deteriorating, but not improving much either. Loans to companies beat expectations, coming in flat, which is better than November, and beat expectations of a fall. The EU money supply fell 0.9% year on year in December, which was slightly better than November, but shows that the EU money supply is still falling, and that hopefully means inflation should be coming down or continue to be coming down.
Just comment on that chart though, Keith. It's the same as the UK one. The period 2000 to 2009 saw the money supply approximately double. And then from 2016 to 2020, both where we didn't have inflation, 2016 to 2020 where we didn't have inflation, it went up by roughly 30%. And it's gone up by another 25% from 2020 to 2023. And we've had a lot of inflation. So I think the linkage between money supply and inflation is you have to be careful you don't exaggerate the effect of that linkage. There are other factors as well. That's
true. You'd expect the money supply to grow in line with economic growth.
Yeah.
And, in the period, 2012 to 2020, the economy was growing. What's happened in 2020 was there's a big increase in the money supply, but no growth. And so you then got just a change in the price level.
Yeah, that's a fair comment. It'd be interesting to see the disaggregated data, wouldn't it? Not tonight.
And the Citigroup Economic Surprise Index has turned back down. Previously, it seemed to be heading back to zero, but now it's minus 40. In summary, the EU manufacturing PMIs were downgraded, service PMIs were upgraded, leaving total unchanged. So the EU seems to be in a mild recession, which is not improving or deteriorating. However, the Citigroup Surprise Index is falling. Hopefully, inflation in the Eurozone is coming down. The US, Richard.
Thank you, Keith. So US global manufacturing PMI below 50 and falling back down a bit and worse than expectations. The US global services PMI just rising up a little bit, slightly better than expectations and a little bit above 50. So the composite, again, is just a little bit above 50, but was worse than expected. And the ISM manufacturing PMI is well below 50 and isn't really going anywhere at the moment. The ISM manufacturing employment is below 50 and it's in a sort of noisy downward channel. And the ISM manufacturing new orders rose up to 50, but it's stalled. So worse than expectations.
Yeah, new orders have been shrinking for well over a year now
Yeah.
and continuing to fall.
And the ISM manufacturing prices paid falling slightly, so below 50, but fairly stable, really.
Yeah, but good evidence of further disinflation.
Yes. The US job openings continuing to fall, and it's sort of, if you follow that trend up from 2008 to 2016, it's sort of roughly on that line now.
It is, yeah. Good point.
And the quits rate is also falling, continuing to fall quite sharply. So jobs and quits rate tend to lead wages with a 9-month lag. So you'd expect the wage rate growth rate to fall to somewhere between 4 and 5% over the course of the next few months. And the hiring rate is falling steadily. So the quit rate is falling, and the hiring rate is falling. So employers are being cautious and employees are being cautious.
Yes.
And hiring tends to lead non-farm payrolls by about 9 months. So you can see that would suggest that non-farm payrolls is in for quite a big fall over the next few months.
Yeah.
Suggesting that part of the economy is slowing down, but layoffs remain low.
So I think what we're seeing is that both employers and employees becoming more cautious. So employees don't want to leave and employers don't want to hire.
Yeah, but they don't want to lay off either because they don't want to they don't want to lose their skilled staff.
Yeah.
So US construction expenditure month on month is worse than consensus, significantly down, and actually is quite low. Although if you go to
well, the thing is, it's grown throughout the whole year, which is very much against expectations given the rising interest rates. So it's be amazingly resilient.
US Chicago Fed National Activity Monitor. Again, this is a really sort of, but the graphs bounce all over the place. So it's hard to know what this is telling us.
That's true, but it's saying that in November it was growing in line with its historic average.
Yeah.
So the bottom line is, according to that, US economy is doing absolutely fine in November.
Case-Shiller House Price Index month on month continuing to decline, but we've still got house price rises.
Yeah.
And the house price index is showing the same thing year on year, rising up from just below 0 to about 5%.
Yeah, absolutely amazing and mystifying to me when you've had this massive rise in interest rates.
Yeah. And pending home sales month on month, 0. As in it hasn't changed.
Yep.
And year on year, pending home sales are sort of climbing out of that trough.
Yeah.
Heading up towards 0. And the Challenger job cuts are really giving no data other than things are as normal. And the ADP employment change is better than expected.
Yeah.
Quite a lot better than expected, actually.
Yeah, there seems to be, frankly, quite a low correlation between the ADP and non-farm payrolls. A reminder, non-farm payrolls is out tomorrow. We will be reporting it next week.
The Chicago Business Barometer, quite a spiky sort of chart, but it's showing a definite noisy upward trend at the moment.
Although December was a bad month, back down.
Yeah. And Redbook retail sales doing very well. Mind you, we are heading in for this presumably is Christmas spending.
Yep.
30-year mortgage rates fallen to about 7%. And the mortgage market index is still actually on its knees. It's really doing very badly.
Yeah.
US initial jobless claims are saying recession. What recession?
Yep.
And continuing jobless claims having sort of risen in the autumn have now stabilized and are saying there's no problem here. And the New York Fed weekly economic GDP estimate, which we discussed previously, and which I'm a bit dubious about, is suggesting 2.9% GDP growth rate. And the Citigroup Economic Surprise Index, again, this is a graph that I find difficult to interpret because it's so noisy.
It is, but I think it's got it. I personally think that if I was going to choose one economic monitor, I would have choose this because it got 2023 absolutely right in the economy outperforming expectations for much of the year. Now, what's interesting is it's now falling again. But as we go through the data, Richard, I couldn't see that many variables which have missed. So I don't quite see why it's fallen so much.
Yeah, no, well, I agree. There's not much data that's missed, is there? And if it has missed, it's only a small miss.
Yeah.
And the Atlanta Fed GDP now, Q4, is at 2.5%. Interesting. So we've got a summary of the latest estimates suggest that US GDP is continuing to grow, and the GDP now, both GDP now forecasts confirm that. The PMI is remaining pretty resilient in services. Unemployment seems pretty stable, although we've got the quits rate changes and the job openings fall, but nothing particularly significant. Citigroup Economic Surprise Index is weakening a bit. So the US economy is still withstanding the higher interest rates very well. And we do still expect the US economy to slow, but I feel a little bit like a broken record with this one, Keith.
Well, you're absolutely right, mate. We've been saying this for a very long time now. But in my review of the year, I look at the forecasts of all the economists, and everyone got everything wrong. It's not just us.
Yeah.
Anyway, moving swiftly on to China. Now, we had both the National Bureau of Statistics and the Caixin PMIs. The NBS showed manufacturing sector weakening. The non-manufacturing sector strengthening a bit to just above 50, with the result that the composite continued to decline towards 50. So the official National Bureau of Statistics PMI shows the Chinese economy stagnating and weakening slightly in December. But if we now move on to the Caixin private sector PMI, we get the opposite picture. So the manufacturing PMI actually strengthened a bit, beating expectations. The services PMI bounced quite substantially, massively beating expectations. So that meant the composite rose substantially to 52.6, massively beating expectations. I have also found a source for the Citigroup Economic Surprise Index for China, and you are looking at the red line, and that remains just below zero. So the Economic Surprise Index would seem to agree with the NBS that the Chinese economy ain't doing so great. And Chinese real estate investment has now fallen for 2 years in a row. And I thought this was really important. Wages in China are actually falling. So we know prices are falling. Declining wages are not a good indicator of a strong and healthy economy.
They're not. And also, we always hear about the China's demographic time bomb with the Chinese working population gradually getting smaller.
Yeah. Well, we also know they stopped reporting youth unemployment when it got to 23%. So, not indications the Chinese economy is doing very well. So once again, it's very difficult to know how well the Chinese economy is actually doing, but falling wages and deflation suggest it ain't doing that well. And onto one chart. Now, this is from Florian Kronewitter, and he has sold all his equities because he thinks that corporate earnings estimates, reminder, the market is expecting a return to decent earnings growth in 2024. He thinks they're way too high. And the orange line on this chart are average hourly earnings, and the green line is core PCE inflation. And his point is that revenues for companies are PCE inflation and their costs are hourly earnings. And so what you're seeing there is margin compression. And so the market is complacent at the moment, thinking that earnings will grow in 2024 and the economy will do just fine. Well, margins come under pressure, then corporate earnings could well disappoint to the downside. And on to inflation watch, Richard.
Thanks, Keith. So the new data this month is the Japan inflation rate is down 2.8%, CPI 2.5%, core CPI. And
Yeah,
that's for November, and we're awaiting now the December figures.
well, EU flash estimates for December are out tomorrow. But they're talking about the Japan number. They just can't sustain inflation. It's amazing.
No, even with all of their money printing, they can't sustain it, can they? So the year-on-year fall in the US money supply is the worst since the Great Recession. We don't appear to be in the same economic situation as yet, at least, do we?
Yeah.
Although you would expect it to be, this is coincident with recessions if you go all the way back. So something strange, something slightly out of kilter with the US economy at the moment. These charts show that we've got disinflation in goods, but that service inflation is high and maybe picking up again, which suggests the Fed has not finished the task of controlling inflation, even though it's flagging that it will be cutting interest rates.
Well, I think market's got a bit of a head of itself. I just can't see the Fed cutting rates in March unless the economy really slows down.
Well, the issue the Fed has got is that they of course always tend to favour the incumbent government, and the incumbent government will want interest rates to fall for the presidential elections later on this year. So they will be under some amount of political pressure, even though ostensibly they're independent. In reality, they're not. They'll be under quite a lot of political pressure to make the economy sing, and pushing it into recession by interest rate rises, high interest rates, isn't going to do that.
True. So I think everyone is expecting the Fed to cut rates in 2024. It's just I don't expect them to do it in March. They're going to do it later in the year.
Another thing to bear in mind is that in previous bouts of inflation, it's highly unusual that inflation is a once and done phenomenon, and it tends to subside in waves. And this would be, if it would happen now, there may be a bit more of a downward wave to go, but then there'll be another upward wave, but not as high as the previous one. That would be quite sort of typical of a bout of inflation.
Yeah.
So, whether that happens, of course, remains to be seen. So the US saw a lot of deflation in foodstuffs and energy in November, and you can see there, particularly in eggs for some reason.
Well, eggs are previously, yeah.
I think fuel oil and the reduction in prices of energy is the one that's most significant for the economy, and quite a lot of goods and services prices fell also.
Yeah, I thought this was really interesting, actually. Some of these are big. Price of appliances, TVs, computer software, down in nominal terms.
They're large drops, aren't they?
So, seems that inflation is coming down.
Yep, I would completely agree. US apartment supply is surging, which you'd expect to put downward pressure on rents. And of course, one of the things we've been wondering about is the constant supply of multi-family. Is it multi-family?
Yeah, multi-family.
Multi-family units in in construction, and more and more coming onto the market. And as so downward pressure on rents is going to have a significant impact on the overall inflation rate.
Well, I had a conversation with my American fund manager friend earlier today, and he was saying that part of the continued strength in multifamily construction can be put down to two things. First of all, the developers bought options on land at low prices in 2018, 2019, 2020, and they have yet to fully exploit that historic land bank, and so their costs remain cheap. Bear in mind that US land prices have since surged about 20%, so that gives them an incentive to actually buy the land. But also they signed the funding agreements back in during the pandemic, and so their money is cheap, and they therefore have an incentive to build it using borrowed money. And if it all goes wrong, the bank is on the hook rather than them.
And presumably the facility is time limited. If they don't use it at whatever rate they negotiated several years ago, they then have to fund it at a much higher rate. So there's significant incentive for them to do it now.
Yeah.
So US small business wage plans show that small businesses are intending to start raising wages again, which is a potential inflationary effect.
Well, this is your point, Richard.
Yeah.
Inflation coming in waves.
Yeah.
That would be bad.
And of course, this issue with the Middle East is bound to be inflationary. So it can also be exogenous effects, can't it?
True.
US Trueflation is currently measured at 2.17%, which is very low.
Yep. Back down again. So, I've honestly, there seems very little inflation in the US currently.
And UK Trueflation is currently at 3%, which is much more comfortable than 20%.
Yeah. And the speed of the disinflation in the UK has been absolutely extraordinary.
Yeah, 10 months that's taken.
Yeah.
It's all down to Rishi Sunak, I believe. We don't make political comments. All the indications are, so in summary, all the indications are that inflation is falling everywhere.
Thank you, Richard. And while we talk about inflation, I this week found a new data source on global labor markets. So quickly, let's go through it. And this data source is the St. Louis Fed, and they have data on job postings on Indeed over time for a number of developed nations. So this is Australia, and the numbers are extraordinary. These charts all start at 100 pre-pandemic. And what this chart shows in Australia is that job postings on Indeed were at 183 in December. So a naive reading of this chart would seem to suggest that the Australian labour market is much, much tighter than it was pre-pandemic. And if we look at just new job postings, you get a very similar picture. 100 pre-pandemic, 167 in December. But if that's the case, how come the unemployment rate in Australia has been rising? I strongly suspect that there's something else going on. I think what's happening is Indeed must be becoming more popular itself. So you're getting a trend in more job postings on Indeed. And if we look at Canada, it's at 119. New postings at 106. Canadian unemployment rate has risen sharply, but according to Indeed, there are more job postings than there were pre-pandemic. France, 151. New job postings also 151. Unemployment rate rising. Germany, 137. New postings 146. Unemployment rate rising quite sharply. UK, actually, only 110. New postings 107. Notice the general trend downwards in the UK. But we know the UK unemployment rate bottomed a year ago and has risen quite sharply since. In the US, 125, again trending slowly downwards. New postings also trending slowly downwards at 135. According to the Lightcast website, total job postings are down 10% month on month, 30% year on year. The unemployment rate in the US not really picking up. So we've previously shown you the Indeed job postings data and said that the higher rate of job postings now versus pre-pandemic is indicative of a much tighter labor market. Actually, after reviewing all this international data, I also think that Indeed itself is just getting more job postings than it was pre-pandemic. And so there's also a secular trend that needs to be taken account. And I think it's probably better to look at the trend in the jobs posting data rather than the level itself. On to Recession Watch, Richard.
Thank you, Keith. So the San Francisco proxy Fed funds rate, it remains very high. So the proxy rate is over 6%. The effective rate is 5 and a bit percent. So clearly, the economic conditions are very tight. And according to the Philadelphia Fed, more than half the states in the US are currently in recession. But presumably, the other half are much more healthy, and that is counterbalancing the ones in recession because the US as a whole is not in recession.
Absolutely.
And this is actually the classic problem, isn't it, of operating a very large country with very diverse economic interests as one economic entity. It's the same issue that the EU has, at least.
Yeah, very true.
So the Conference Board Employment Trends Index has fallen a little bit in November, and it's falling. It's falling. It's been falling steadily now for about the last 12 months, and it has a good track record of predicting turning points in the US employment market. So the red line looks to be pretty well. Actually, even I would admit that it seems to be quite well correlated with the blue line. And as you know, I'm quite hot on spurious correlations. That one, to be, it goes back over a long period of time, and it does seem to move in a similar manner, which suggests that non-farm payrolls should start to fall.
Yeah.
As we know, and we've witnessed firsthand live, monetary policy takes time to work, and this is a chart that shows the spending patterns from the time when the Fed starts hiking, and it takes it's taking at least 2 years, and before any really significant change, 3 years for the spending patterns to significantly change.
I really wonder about. I suspect that's the great financial crisis, frankly.
Right, yeah, having that big impact.
Yeah, having that big impact, but
yeah. And US housing demand is suffering a second leg down, although other elements of the housing market in the US, which we just talked about, are not showing signs of weakness, further signs of weakness.
Yeah, well, this is interesting. So, mortgage approvals are not really rising much, and we know that new home sales had this unexpected fall was it November? Yeah. So, despite mortgage rates coming down, so something to watch anyway.
It is, isn't it?
So what this chart shows is that the market tends to underestimate the speed with which the Fed will raise rates. So if we look at the period 2005, the blue line is where the market expected the Fed funds rate to be when it was predicted 1 year earlier. And they expected it to be at 3.5. The outcome was it was close to 4.5. So the market was far too conservative in its estimate of how high the Fed funds rate would get. But then when we get to the peak, they're forecasting that the Fed funds rate will stay at 5.5% for the next 18 months. In fact, it then collapsed to just around 2%. And the similar pattern can be seen in 2018, 2019. Obviously, that was affected by the pandemic. But here again, we see a similar pattern. The market underestimated the speed with which the Fed would raise rates.
Yeah.
And it's now forecasting that rates will stay about 4.5% going forward. So just wait and see.
So we know that a lot of debt's going to be refinanced at higher interest rates in the coming years. And you can see there the maturities and the different type of debt. And as we've commented many times before, this monetary policy is working with a significant lag. And the global credit impulse continues to decline, which suggests that economic activity will continue to fall in line with the decline in the credit impulse.
Well, investment in particular will be falling, I think we could say.
Yeah. Sorry. So searches for can't pay credit card continuing to rise, but can't pay mortgage and can't pay auto loan aren't showing that pattern.
Yeah. I know, I thought this was really interesting.
Yeah. Maybe, well, I don't know. Yeah. Anyway, it clearly indicates there's some sort of tightness in the consumer credit market. So 12 months change in 12-month credit flows. So the US credit impulse is falling quite rapidly and the rate of decline is continuing to increase.
Yeah. And that means that investment activity in the US is falling, and that should detract from GDP growth. And every time it's fallen in the past, you have had a slowdown in the economy.
Yeah.
You know, the last time it was at these levels, you know, the economy was collapsing.
Yeah. So there are all the signs are still there that the US is going to go into recession.
Yeah.
It just hasn't done so yet. So the increase in US fiscal deficit at around 2.2% to GDP in 2023. And in 2024, I'd like to know whose figures these are. It's expected to subtract around 1.1%. I don't believe that will happen. I believe that US fiscal policy will continue to be expansionary.
Well, it will continue to be expansionary, Richard, but GDP growth depends on them actually increasing the size of the deficit.
Which I believe they will.
Well, I don't think they will. I think that we went through an analysis of the US fiscal deficit and a few months ago, and the reason the deficit rose so much in 2023 was a collapse in tax revenues, particularly because of a fall in capital gains tax due to the stock markets actually falling in 2022. 2023, they had a great year. So actually, they're likely to rise again.
So that's a good point, Keith. So the latest German trucking data is showing that the trucking data basically looks like it's falling off a bit of a cliff here, doesn't it?
Yeah.
And it's consistent. It's a consistent decline. It's not a spike, sudden spike down, some sort of spurious figure. So that suggests that the German economy, even manufacturing output, is in trouble.
Yeah, I suspect there's some seasonality, but you know that is not a happy trend. frankly.
It's not kicked, is it? I mean, it's heading down towards actual COVID dip.
Yeah. So the German economy doesn't look like it's doing very well.
And we know that, don't we, from the fact that they are so dependent on energy.
Yeah.
And they can't afford to run their manufacturing industries. So in the US, leading indicators continue to point to a coming recession in the US. And actually, they are continuing to point in a firmer manner. These indicators are not getting any better.
Yeah.
They're slowly pointing downwards, further down. I don't rate the Citi Group Economic Surprise Indices. I find them very difficult to interpret. I think they're too noisy.
Okay.
However, if you do, then it would suggest that the economy may be weakening. And as we say many times, the rise in interest rates has still to be felt in full.
Yeah.
We've probably got another year to go for that.
And onto the Chinese property market. Well, so during the week, I was digging through the podcast for the year and I came across some charts on the Chinese property market. And I actually went and found the source of those charts, which is an academic paper from 2018, which is an academic paper from 2020 with data up until 2018. Which I thought was really interesting. So bear in mind, this data is slightly out of date, but first of all, it shows that in 2017, the amount of residential space in China per person was already at developed world levels. So even 6 years ago, and there's been a lot of building since, China was not short of residential property. And the vacancy rate, the number of empty properties was extraordinarily high. So bear in mind that Spain and Italy have lots of, I take it they've got lots of holiday homes and things which are rented out and don't have a permanent resident. Well, China has a lot of empty property. And that is concentrated in the tier 2 and tier 3 cities. And the tier 1 cities are very expensive, tiers 2 and 3 less so. Urban home ownership in 2020 in China was incredibly high, much higher than in the US. So there's not much renting out. So Chinese urban dwellers already own somewhere. So who's buying all these properties? Well, people who already have a property.
Investors, Keith.
Exactly. It's all investment money. By 2018, like 5 years ago, 87% of new home purchases were made by somebody who already had a property. And that means the rents are very low. There's loads of property, owned property, and few renters. So when you look at the rental yields, they're abysmal. So this year, housing starts are down 20%. And in summary, we know Chinese property is amazingly expensive by international standards. And the Chinese property market has been propped up by investment buying. So now that houses prices are falling, and we reported before Christmas that the FT were reporting that, contrary to official numbers, Chinese real estate agents in Beijing were reporting real prices were down 10 to 30%, as opposed to less than 1%, according to the official numbers. Once an investment, a property bubble starts to burst, they're very difficult to reflate. And who's going to buy all this new property? And that suggests that the property sector, which has been around 30% of Chinese GDP, will be much less going forwards. And hence, Chinese GDP growth is likely to be lower going forwards. And also, if this property bubble bursts, then a lot of consumers who've taken out loans and property companies will be in trouble, and everywhere else in the world, a bursting property bubble rapidly leads to a financial crisis.
Yeah. And the interesting point you made here, Keith, is that even if the property bubble does burst, there's not going to be anyone who wanted to buy the properties that have the vacant properties. Whereas in the UK, if you have a property bubble, there's always people waiting on the sidelines who will enter the market. But there is too many properties for the population to live in, and it sort of can't rectify itself.
Yeah. And quickly, the US Bank Term Funding Program. Now, reminder, the Bank Term Funding Program was put in after the failure of Silicon Valley Bank, and it allows banks in the US to tap funding directly from the Fed. And that meant they could borrow from the Fed without having to sell their sovereign bonds on which they were sitting on big losses. And that's what caused the failure of Silicon Valley Bank. But the funding from the Fed comes at 1-year swap rates plus 10 basis points, which is a much higher rate than on deposits. And so we have previously talked about how funding from the Fed in the form of the Bank Term Funding Program was very expensive money and would reduce bank profitability. Now, as you can see from this chart, banks are continuing to use the facility, and it's been rising recently. Does that mean that US banks are increasingly stressed and having to turn to the Fed? Well, the answer is no. So what's happened is that the Bank Term Funding Program, the rate is set at 1-year rates plus 10 basis points. But the 1-year rate has now fallen below interest rates. And so banks can borrow from the Bank Term Funding Program and then go and buy bills, short-term bills, or lend to the Fed. And that means they're getting yields of up to 65 basis points. So they're making a turn out of the Fed, basically.
It's a sort of QE, isn't it?
Yeah, it's the unwanted side effect from a badly constructed facility, basically.
Yeah, that's what it is. So soft landing watch. Are we going to have a soft landing? Everybody thinks so. So the easing financial conditions has been extraordinary, as you can see from this chart, and very rapid. And they are now at the same level as they were in mid-2022, but US interest rates were then 3 percentage points lower.
Yeah. And that is entirely dependent on the market expecting a soft landing.
Yeah.
And
a self-fulfilling prophecy, possibly.
Precisely. Yeah.
Okay. So this is a fund management company's asset allocation survey, from which they sort of extract the probability of a global recession in the next 12 months. And basically, this survey suggests it's 51%.
Yeah.
And the median probability since the survey began was 36%. Now, I don't think actually that recessions occur 36% of the time, do they?
No, they don't.
So the median probability suggests that this survey is not very accurate.
No, that's like everyone gets it wrong.
Yeah, very difficult to predict.
Well, but you see how much it's fallen over the last year. So
yeah, fund managers are expecting there to be a 50% probability of a recession next year, which is much lower than what people were considering to be the probability, let's say, 9 months ago. And as we have said, the US employment is actually pretty stable. It's not showing any unpleasant factors that suggest recession is imminent, and continuing claims year on year are actually falling at the moment. So US labour demand has softened a bit, but it's still pretty high. And there are more jobs available than there are people in the unemployed pool. The credit managers index did decline quite sharply, actually, but it's now, I would say, it's a little bit noisy, isn't it? But it's stabilized between 50 and 55%. And that dotted line, I presume, is the line that demarcates growth and recession.
Yeah.
So it's just a bit below that dotted line. In Europe, loads of European companies and households saw a big jump very recently.
Yeah.
A big decline prior to that, very big decline. Now, is that just a statistical anomaly? We'll have to wait and see.
Yeah. Interesting though, because all the indications are that the European economy is not doing very well, but bounce in borrowing.
And so the soft landing is the consensus, and no sign of a hard landing anywhere. So, except possibly actually in China.
On to how does a US government bond auction work? First of all, some terminology. T-bills are bonds with a duration shorter than 1 year. Notes are shorter than 10 years. Treasury bonds are longer than 10 years. Treasury inflation-protected securities, TIPS, and floating rate notes have got various maturities. But all of these can be referred to as bonds. No duration longer than 1 year is called a T-bill. No duration longer than 10 years are called notes. The US Treasury has to raise funds for the US government, which we know is running an absolutely enormous fiscal deficit, and that means it has to auction lots of bonds and T-bills during the year, and it runs these auctions very regularly. There are around 300 auctions a year. As of November, the US Treasury had auctioned off $20 trillion of bonds during the year. Bear in mind, it has to continually issue new bonds, particularly T-bills, to replace ones that are maturing. So the issuance is much higher than the deficit. So how does an auction work? Well, bidders must first of all have an account with the US Treasury, and then they can enter a bid. Now, you can either enter a non-competitive bid, which means you'll just accept the final auction price, or you can enter a competitive bid. Competitive bid means you put a price, and if the price of the bond settles above that in the auction, you do not get filled. You do not get any bonds. If the price in the auction is below the price at which you bid, you will get the final auction price. So the auctions use the Dutch system. Imagine that the Treasury wishes to auction 100 million of new 10-year notes and has received non-competitive bids for 10 million. So those 10 million will just accept the auction price. Step one, it first accepts the 10 million. It then needs to raise 90 million in the auction. And it goes to the order book. Now, imagine this is the order book. It needs 90 million from that order book. And so it will accept the 25 million at the lowest yield, the next 20 million, the next 30 million, that gets it up to 75 million, and then it'll accept half the 30 million at 4.05%. And the auction price is set at the highest bid accepted, i.e. 4.05%. So all bidders will receive that final auction price. So bear in mind, the 25 bid at 3.88%, they were willing to accept a lower yield than they actually got. They got a much better yield at 4.05%. The bidders who bid 4.05%, only half of those bids were accepted, they get prorated. So how do we tell whether the auction went well or not? The first thing to look at is the bid to cover ratio. That is the ratio of the total bids relative to the bonds on offer. In this case, there are 130 million's worth of competitive bids plus 10 million of non-competitive bids for 100 million of 10-year notes offered. The bid to cover ratio is therefore 1.4. The blue line is the bid to cover ratio over time of the US 10-year. And you'll see it's been incredibly stable. Even during the big bond sell-off earlier this year, there were no trouble with the bond auctions. The second way of telling whether the auction went well is the snap. Now, the snap refers to the price of the bonds in the pre-market trading interbank. And so banks will trade the bonds for settlement in the auction, and they will establish a price they're expecting to receive in the auction, which is called the snap. So if the final auction price is above the snap, i.e. the yield is below expectations, then the auction's been good. If not, it's been bad. So if the snap in our scenario had been 4.02% and the final auction was 4.05%, then the yield is above the snap. So the Treasury has had to pay more than it would have liked to get its funding, and the price that auction would be regarded as poor. If the snap had been 4.07%, then the snap would have been good. The final one is the auction tail, which is the difference between the average price in the auction book and the final auction price. So if we go back and do an average sum of the prices in the order book and then compare it with the final auction price, then if there's a big gap, that means that there was low demand, which was a bad sign. If the average price in the order book was below the final auction price, then the auction is regarded as having gone incredibly well. So bottom line, a high bid to cover ratio is good. If the auction price is below the snap, that's good. And if the auction had a small tail, that is good. The bid to cover ratios have been stable at about 2.5 times for a good few years now. And there is no indication that the rise in Treasury issuance is meeting lower demand. Richard, any thoughts?
Yeah, it's interesting, isn't it? It's quite a complicated process. But what is interesting is that the demand, despite the huge issuance, the demand remains very stable. But I know that coming up in this next 12 months, there's a lot of short-term treasuries that need to be refinanced, aren't there? And whether they will run into any auction difficulties over this period of time remains to be seen. But there is huge demand for these things.
Yeah. On to other charts, Richard.
Thank you, Keith. So the US government has a lot more to spend. So this is 70% of the CHIPS Act spending and IRA Act spending has yet to be spent. So that's an awful lot of money to come through into the economy over the next few years and over the next, 8 years or so. So the US economy is going to continually get this boost from the CHIPS and the Inflation Reduction Act.
I should say, though, that Trump has said he's going to, cancel the whole thing if he gets in. He's certainly going to cut back hard.
Yeah. Okay. So depending on which side of the debt fence you are.
Yeah.
Fingers crossed. And this is a chart showing the US housing market, the home price index against affordability, which the two are just sort of bifurcating, continually bifurcating.
Just insane.
Yeah.
Really. And on to good news. Well, thank you to our Discord member, Richard Wilk, for sending this. So this is a picture, believe it or not, of the demilitarized zone between North and South Korea, which in my mind I had as, full of barbed wire and unexploded bombs and mines. But actually, it turns out that it's a very long wildlife sanctuary that runs coast to coast over mountains, through rivers, etc., etc. And because there haven't been any human beings in there for the last 70 years, it's turned into a wildlife haven. So, the moment you get rid of people...
Yeah, it's become delightful, Keith.
It has, yeah. So wildlife surveys have shown 6,168 species within the 8 areas of the DMZ that they've surveyed. And of the 267 endangered species on the Korean Peninsula, 102 of them have been found in the DMZ.
Well, perhaps we need a bit more conflict in the world.
Well, yeah, get rid of the humans.
Yeah, well, I think the Chinese tried that, didn't they?
On to equities. Richard.
Thanks, Keith. So 2023 equity market performance. So the FTSE All World Index up nearly 20%. FTSE All Share only 4%. And of course, the outstanding performer was NASDAQ up 43%, the Magnificent Seven. And Bitcoin did extremely well as well.
Yeah.
Very unexpected as far as I was concerned.
But to pause, take a look as we enter a new year. Generally, amazingly strong equity markets led by the NASDAQ.
Yeah.
But China not doing so great.
No. And there we have some charts, the FTSE All World Equity Index and the FTSE All Share, Stocks 600, the S&P 500, and NASDAQ, and Russell 2000.
Russell 2000 has had an absolutely extraordinary 3 months.
Yeah.
It's up 26% from its lows. And now it started the new year giving back 3.2.
Yeah.
And actually, when you look at it, it has had these surges to 2000.
Yeah.
And then just gone back down again.
Yeah. Hasn't been able to sustain itself above that, has it?
Yeah. So let's see what happens.
And the Hang Seng on a trip to nowhere.
Yeah. Starting this year, very much as it ended last year, going down.
The topics, which is indomitable.
Yeah.
As is Bitcoin, actually.
Yeah.
And there's the British pound and the euro. I mean, basically the pound and the euro are just in these big trading ranges.
Yeah, agreed.
And the dollar index, which is likewise in the same trading range, only inverted. There's the VIX, which is very, very low. One day, Keith.
Yeah. Well, exactly.
I look at the 2024 summarise, the Magnificent Seven. And that's the S&P 500, looking rather tubby there, Keith.
Yeah, but quite relaxed. Good lunch.
Yes. So the FTSE 250 Total Return Index is down 13.7% from its 2021 peak, but it returned 7.2% in 2023. It's not too bad.
Yeah.
And the AIM index is down 42% from that over that same period and returned almost minus 9% in 2023. AIM is a happy place.
AIM doesn't look good, does it? Long-term performance.
Yeah.
Going back to 2014, being invested in AIM.
And these are supposed to be high growth companies.
Yeah. Not great.
And fund managers are all in on equities. That means they're a safe place to be.
Actually, they've got an exposure of 103%. How does that work?
That's good. So well, they were right last year, Keith.
Well, that's true.
Extreme greed, which is what we currently have, is not a good time to be buying the market from a historical point of view.
Yeah. Actually, Paul, just go back to this. I think they got it totally wrong, didn't they? So they cut their exposure to equities to November when the market bottomed.
Oh, yes, quite right, Keith. Yes,
then they started piling back in.
Yeah, they did.
Chasing the market.
And they're all buying the Magnificent Seven.
Yeah.
Now they've all made their profit and all get out of it.
Yeah. So
the aftermath of bubbles leads to long periods of real underperformance for equities. So the S&P 500 has, basically just done a series of stair steps higher, but each step is a long step. So what's going to happen? Is it going to go higher, or is it then going to basically plateau-ish for 10, 15 years?
Yeah.
I know, I think it'll plateau, but Are we still in a secular bull market, or have we entered a secular bear market? No,
Yeah.
I think. Well, my view is that we're not in a secular bull market anymore, or that we won't
Yeah.
be very much longer. But
Well,
my view,
I, sh I should say that both these charts were from earlier in the year, and the S&P is hovering around its all-time high at the moment.
yeah.
But is it going to be a double top?
And we've got this anticipation of a return of earnings growth, which is one of the reasons the market has risen so strongly.
Yeah,
We've also got a bit of a tech boom, obviously,
that's true.
and the S&P actually beat all the analyst predictions in 2023
Yeah,
by a lot in some cases. And goodness me, look at the put-call ratio at its lowest in history, which everybody's got call options. And as we've discussed many times, we have these magnificent 7 dominating the market, and you can see that domination graphically here. However many of you held the Magnificent 7, well done. And
yes.
we don't give advice, but I don't hold any, and I wouldn't be buying any at this point.
Well, I'm saying, I mean, Tesla, really?
But
But
Nvidia, I mean, it
yeah, well, Nvidia has actually had extraordinary revenue growth.
has.
Tesla hasn't.
Agree. No. Anyway, there we are. I've been wrong about them for so long that I've given
Yeah.
up being wrong about them.
Well, same here, mate.
And the ratio of the Nasdaq to the Russell 500, Russell 2000 hit a new high in the year, higher even than the tech bubble. And it's a pretty noisy chart actually, but the Russell has done very well in the last 2 months, catching up with the Nasdaq.
Yeah, not time to be buying it, I'd say.
And retail sentiment is very bullish.
Yeah, basically, it just follows the market, though.
Yeah.
You know, market goes down, sentiment falls. Market rises, it goes up again.
Outside the top 10, S&P valuations are not particularly expensive as long as there is not a hard landing recession.
I.e., as long as E doesn't fall.
Yes, exactly. And the market sentiment has it's a very noisy correlation, but you can see there is one there. But right now, the correlation is broken down between investor sentiment and economic sentiment, which doesn't feel very safe if you're invested in the stock market.
Yeah, I think the stock market's got a bit ahead of itself, frankly.
Yeah. And I think some people are anticipating there's going to be more QE as well. Andreas Steno-Larsen is forecasting a big jump in market liquidity from central banks in the coming quarter, i.e. effectively more QE. Will this support equities? Well, yes, it will actually, because you look at the graph of QE versus, or the Fed's balance sheet versus the equity market, they're almost perfectly correlated.
Well, the thing is, we did this last year, Richard, and they were perfectly correlated up until November when equities took off. And, there wasn't an increase in liquidity. So, I'm skeptical, actually. Just
Buy gold, Keith.
Well, gold didn't shoot up with QE either, frankly.
No. So this is the target outlooks for all the various strategists, as they like to call themselves. And the average forecast is it'll be at 48.75 for the year, which is only 2.2% above where it was at the start. And
yeah,
there we go.
Well, you saw how accurate they were last year, but
so analysts continue to expect strong 500 earnings growth next year, as we just said. And this is the calendar year bottom-up earnings per share actuals and estimates. So for well, look at that and see if you can work it out yourselves, I would suggest.
Well, the thing is, they're expecting a resumption of earnings growth.
Yeah.
Next year. I'm skeptical that we know we're expecting GDP growth certainly to slow next year. Yeah. I can't see how they're going to get earnings growth of 10%, particularly as we started this week with the Florian Kronovitz chart showing, expecting margin compression. If earnings fail to match expectations, I think that's bad for equities, surely. Although, frankly, it didn't seem to be this year much.
No, it's like don't understand it. And big businesses, I think we've seen this sort of chart before, where basically big businesses haven't suffered the pain of higher interest rates because they've got a lot of cash.
Yeah, absolutely. And they locked in all their funding,
Yeah.
during the pandemic.
And the cycle low, the stock market usually trades at a low PE ratio. And if it has bottomed, then it has bottomed at a record high PE ratio.
Yeah.
Stock market tail events become more common in recent years, fat tails.
Yeah. Well, I agree with this. I think the market's just become much more volatile.
Yeah. Investment return expectations do seem very unrealistic for what we think is going to happen. Look at the investor, which is private individuals versus financial professionals. Mostly they are much more optimistic than the financial professionals.
Yeah. On to commodities. Thank you, Richard. Well, commodities, unlike the stock market, had a very poor year, down 12%, Bloomberg Commodity Index. And energy commodities, the EIA are forecasting the world energy consumption will rise by a further 25% by 2050. Pause, take a look. And sadly, they're forecasting that our consumption of fossil fuels will largely be unchanged. And in fact, oil consumption will continue to rise, replacing coal. So currently we consume a lot of goods and commodities that are only produced using fossil fuels. So plastics, fertilizer uses a lot of natural gas, steel uses a lot of coal, cement uses a lot of natural gas. And as long as our consumption of those rises, so will our consumption of fossil fuels. So how did energy commodities do in the year? Well, not well. Brent down 10%, WTI down 10%. Dutch natural gas futures down 57%. That's great news for European consumers. US natural gas futures down 44%. Coal down 63%. Uranium, the standout, up 86%. So Brent this week was pretty much unchanged. Crude, WTI also unchanged. Some numbers specific to the oil market. Well, this is change for last year, and over the course of 2023, US inventories built, and US crude production grew by an astonishing 1.3 million barrels a day, i.e. by over 10%. Amazing, and that was achieved with a falling rig count. All the doomsayers saying that the shale revolution was peaking and the US was going to struggle to raise production, well, they've been proved wrong, at least in 2023. This week, we have had as yet no new information. Contrary to market expectations, gasoline demand actually rose in 2023. So there is just no evidence that oil demand has peaked as yet in the global economy. And the EIA is forecasting that oil production will rise by around 400,000 barrels a day in 2024, and while consumption will rise by 1.3 million barrels a day. So the market should tighten. Now, the EIA is therefore forecasting that we move into deficit in the oil market in Q1, and then the market is more balanced for the rest of the year. So far, we have seen no evidence of a tight oil market in that Brent has not rallied. But over the next 5 years, the IEA is expecting global oil production to rise by a very substantial 5.8 million barrels a day. Pause, take a look. And JP Morgan are forecasting that oil consumption will continue to rise. So oil will still be needed for many years to come. But HFI Research are saying that they think US oil production has actually started to fall. So that would mean tighter oil markets in the coming year. The average American consumes about 22.5 barrels of oil per annum. The average Chinese national consumes 4 barrels per annum, Indian 1.3. So as the wages of Chinese and Indian nationals converge with the US, presumably so will their oil consumption, and there's not enough oil for everyone to do that. So the oil market, frankly, will tend to tighten unless we have an accelerated energy transition. Dutch natural gas futures bounced by 4.3% during the week, and very mild temperatures in Europe mean low gas demand, and you've seen gas prices have fallen during the winter. And I thought this was amazing. This is the temperature anomaly in the Northern Hemisphere compared to 1901 to 2000. This year, with 3 degrees above that. And the trend is relentlessly upwards. As a result, nobody's using much gas. So storage levels are near record. And even in the US, gas storage levels are well above average time of year. And the US is now the world's largest LNG exporter, ahead of Australia and Qatar. UK natural gas futures also bounced a bit this week in the cold weather, but well down from earlier in the winter. And actually not spiking in the winter period, which is what you normally see. US natural gas futures, however, they're having a cold snap. Prices rising. Coal had a terrible week, down 12%. That little recovery in the coal price is over. Uranium looks good. Industrial metals, Richard. You're on mute, mate.
Thank you, Keith. So we've got some big annual changes that we have discussed during the course of the year. But aluminium actually was probably the only one that aluminium and copper really remained pretty much unchanged for the course of the year. Everybody else, apart from tin, significantly down actually. So it was a bad year for, generally speaking, a bad year for industrial commodities.
Well, actually, the standout was iron ore. That's up 20%.
Oh yeah, good spot, Keith. Yeah. So, but nevertheless, a lot of them really, really very significant drops: lithium carbonate, nickel, neodymium, vanadium, vanadium, cobalt. A lot of big falls there.
To get spoiler alert, in my key lessons of 2023, we go through all the commodity bubbles of the last couple of years, and they tend to last, the rise tends to last about 2 years, giving you time to get in, but then you've got to sell. I mean, the price performance of neodymium and lithium is just absolutely off scale.
Yeah. So there we have, this is just the charts, normal charts. There we have aluminium, which is down a bit last week. Cobalt unchanged. Copper down a little bit. Chromium unchanged. Iron ore continuing its rise upwards. Chinese ore stocks are now low, supporting demand, but Chinese steel mills are operating at a loss. I mean, China's property market uses up lots of steel, so we don't really know what's going on in China, whether they're stockpiling or what.
We don't.
Lithium is sort of stabilized for the last few weeks. Neodymium looks like it's going to go down a bit more. Nickel sort of stabilized again for over the last few weeks. Tin is just bouncing up a bit as a general trend. Ferrovanadium is rather giving up the ghost, really.
Yes. Yeah. I think there's no interest.
Yeah. And zinc is down a bit on the week, but pretty much where it was back in the spring.
Yeah, I think generally markets giving back a bit of the Christmas optimism.
Yeah. So precious metals, So gold was up 13% for the year, silver pretty much unchanged, and the other precious metals significantly down for reasons that we've really discussed. So a lot of central bank buying of gold over the year.
Mhm.
And so there we have the gold chart, and Russia and China selling US Treasuries, buying gold instead. So I think central banks bought about 1,000 tons of gold last year, which is
Wow.
significantly more than they normally buy. And obviously the use of US Treasuries as a sanction against countries that the US doesn't like has seriously damaged the viability of holding US Treasuries in some countries' coffers as a way of holding assets. So a lot of non-aligned countries are actually getting rid of their US Treasuries because they don't trust the US. BRICS plus gold reserves are rapidly rising for reasons that we've discussed. And also, I think they may be trying to develop a currency that is independent of the US dollar, a rival to it, which would probably have some form of gold backing. And gold remains 20% below its 1980 peak after adjusting for inflation. It is supposed to be an inflation hedge, of course, but
Well, there was an extraordinary spike.
it was, yeah. So there we have silver, which is down 5% on the week, quite a big drop, but silver is very volatile. Platinum had a little bit of a bounce late last year, which looks it's given a bit of it up. And rhodium actually pretty flat for months and months. Looks like there's no market really. Palladium had a big bounce up and a big bounce down. It is a ceiling.
Thanks, Richard. On to rates. And this is the yield curve, still down on where it was a month ago, but actually its bonds have had a really bad few days in the UK. This is the US yield curve. And if you compare the two, you'll see some anomalies actually. So US rates for 5 to 10 years are substantially above UK rates, but then they dip below at the 30-year. Very odd. Don't really understand the shape of that yield curve. If anyone can enlighten us, please write in. The last 2 months of 2023 were extraordinary for bonds, the highest 2-month gain ever, although we're giving that back a bit now. But there's been a lot of profit taking since then. JP Morgan clients substantially cutting their exposure, taking profits. Now, during the year, the US Treasury issued bills, that's green, and didn't issue many bonds. So that obviously meant that helped the supply-demand balance for bonds, but at some stage they're going to have to start selling bonds again. Although, of course, QT means that total sales of bonds were greater than just Treasury issuance, as shown on this chart. Okay, moving on to some charts. Well, last couple of days, actually last week, there's been a big bounce in bond yields and profit taking, market getting a bit ahead of itself, frankly. So UK 2-year, 10-year, very nasty, strong bounce, nasty for me. 30-year, even worse. That's a big bounce. And UK 30-year at 4.4%, best part of. US 10-year also had a bounce off its recent lows. German 10-year has joined in. I'm surprised because the inflation in the Eurozone is going absolutely nowhere. Italian, everywhere, bounce over last week. Market got a bit carried away. And concluding comments. Well, the way I see it is there are two possible interpretations of the relative resilience of the US and UK economies. One is that interest rates no longer seem to work at slowing the economy and that we are headed for a soft landing, in which case we're close to the bottom of the cycle and equity markets will take off when earnings growth continues as the economy bottoms and recovers. The alternative view, which is my view, is that interest rates just take a long time to impact the economy. And the changes in the structure of debt, so in particular US mortgages now all 30-year, and US corporations locked in a lot of their debt during the pandemic, means that higher interest rates haven't affected large sectors of the economy, but they will do. So interest rates are just taking much longer to impact the economy, and eventually the economy will slow. Now, the flip side of that is that just as higher interest rates haven't really slowed the economy, the lags mean lower interest rates will also take a long time to stimulate the economy. So if we do get a recession, then interest rates will fall harder than the market currently expects. Richard, any thoughts?
I completely agree, Keith. I think that number 2 is what's going to happen.
Yeah, we've been saying this for a long time now, but the lags are long.
At least a year.
How have you got on last year and this week?
So I was going to do an analysis, which I'm afraid I haven't done yet. I will do so. So last year, I was actually, roughly speaking, I broke even last year, mainly because although the gold was up 13%, the gold equities, precious metals equities, didn't perform particularly well. And I have made no changes to my portfolio. I'm firmly convinced that the overall global indebtedness is far too high, and that I don't believe that inflation is out of the way. We shall see whether I'm right, but I think we're going to have a bounce in inflation. I also think the governments will have to revert to QE at some point. And as I've said previously, in some senses, Keith, you and I are the same, two sides of the same coin. In terms of that, and my position is gold, and your position is fixed income. So I have made no changes to my portfolio other than I have added very slightly to my position in uranium, but only just to top up it slightly on a couple of shares, but nothing else. How about yourself?
Well, after an extraordinary rally in the last couple of months of the year, I closed the year only down 3.8%, which was some sort of a triumph, frankly. And actually, when I look at my longer term performance, I do all right, It's like it's just got it. I take a lot of risk. I got it wrong last year, So, but
timing, I think, your timing was out, Keith, but that's notoriously difficult. I don't think you can kick yourself for that. I think the concept is fundamentally valid.
Well, I hope so. So what the last few months have shown us is that when the Fed does start cutting rates, then bonds will rally. Now we're arguing currently about anticipation of when they start doing it, and the market this week has kind of rode back on its expectations they were going to cut starting in March. I think that was just fantasy. March is just way too early. But at some stage, they will start cutting. And then this trade really starts to work. Up until then, it's just volatility, I think. But since then, I've had a totally shit week in the first 2 days of the year, down 4.2%, things. And frankly, so I did this after the close today, but I don't think the portfolio had really taken in further falls today. So, we're back again at my portfolio doing shit after having, a good couple of months.
Everything is so volatile, Keith. That's extraordinarily volatile.
Anyway, this is true.
Yeah, if only we'd invested in NASDAQ, eh?
Congratulations to the 100% of our viewers who've done a lot better than me in the last year, despite me doing lots of work. There you go. And yeah, this is, what's happened to T68, it was the best part of 79, like a week and a half ago. Suddenly today it's at 68.3 and, very painful. But you hold it, you're getting 4.2%, So, I'll just sit. I'm very confident that I'll do all right out of this.
I'm sure you will, Keith.
And I should also add that the secret fund manager was big in uranium and he made 25%.
Wow.
Yeah.
Bigger than me then.
Well, absolutely. And he's now trimmed his position. So, I hope you all had a better 2023 than I did. But anyway, thank you for sticking with us. Welcome to the new year. Please, can you press like and subscribe to the channel? And in the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.